All right, guys, so let's talk moving averages. In Forex, there's a lot of different indicators, and probably the most basic and probably most commonly used is the moving average, and we're going to talk about that. So I'm going to try to make this as brief as possible, but I want to give you some good information on what is a moving average, how to use a moving average, and maybe even some strategies on profitably trading with moving averages. So anybody who knows me knows that I'm a price action trader. I really do not use a lot of indicators, and just for clarity's sake, I just want to say that this setup that you see here with the moving averages is not my setup. This is really just the setup for today's training, just so that just so that I can show you what moving averages are all about. So this is generally what my chart looks like when I trade. I don't have much on the chart. I may drop a line in, something like that, or I may drop a trend line in, something, in there. But actually, I don't use a lot of indicators. Now, a moving average, let me start by saying this. A moving average is a line. So let me show you a simple moving average. This line that you see, this yellow line, is a simple moving average. It's called a 10 moving average, or a 10 SMA, simple moving average. So a moving average is basically just what it sounds like. It is a moving number that goes with, it's going to line up with the last candle, okay? It's always going to line up with that last candle, the end of it, right? Just like that. And wherever that line is, so let me drop that line back on there for you. The end of that line, or at the current price of the candle, is going to be the average price of the last, whatever the number is. In this case, it's 10. So some people have asked me, why do you use a 10 or a 9 or a 20 or a 50? What do these different numbers mean? Well, what those are is time periods. So if you were to take a 10 moving average and count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, it's going to take from here forward, and every one of these candles at the end of the candle, at the close of the candle, in this case, it's a 4-hour. So at the end of every 4-hour period, whatever that price is, it is going to take the average price of the last 10 candles when they close, and that's where your line is. That is where this currently is, okay? On a simple moving average, it takes just to be clear, it takes the closing price of the last 10 or 25 or 50, depending on what number you're using. It takes the closing price of those previous candles, averages that price, those 10 or 20 or whatever, 50 prices, gets the average number, and that average number is where your line is, okay? It's where the end of this line is, where I've got my vertical line. So right here. So that little circle right here, let me just kind of highlight it one more time. I just want to be real clear. The end of this line right here, right where that rectangle is the average price of the last 10 candles that you see. So from here forward, from that line right here, the candles, any candle in front of that line is that line. The end of this moving average is the average price between those candles. Okay, so I hope that makes sense. I'm gonna move forward. That should make sense to you at this point, and I'm gonna move forward from there. Now, there's also a thing called an exponential moving average. Now we're talking about a simple. Let me hide that one, and let me bring out the exponential. Now, so what is the difference between an exponential or a simple moving average? Well, to explain that, let me help you understand the problem with a simple moving average. The pro is just what it sounds like. It's a simple moving average. It's very simple. So when you look at it, it is just straightforward. The closing price of the last 10 candles, here it is. Boom. That's it. All right. However, the problem with a simple moving average, because it doesn't take into account the price in between the candles. So like when this candle right here, you see this big red candle here, you know, that started here and ended here. So the price that was accounted for was this low price down here. Okay. It didn't really account for all of this in between. Now during the candle, sure. But when that candle closed and moved to the next candle, the only real price that was accounted for was the closing price of that candle, and it really didn't account for anything in between. Okay? And so because there's such a variation between this price and this price, what happens with a simple moving average is you're prone to spikes. You're prone to sharp moves in the price, on the line. And so that's why you see here where, you know, you see it's going, and boom, it just spikes right up. You know, it just goes right up, when really this was just a pullback, you know. And so it really wasn't a drastic move. It was just a pullback. But because we had such a drastic move here down, now that we have a move up, it's sharp turn up, because suddenly we have a price down here and it's not really accounting for all of the in-between movement, if that makes sense. Now, so what is the answer to that? How do you solve that problem? How do you solve the problem of having a line or a moving average that spikes because it's really only giving you a very simplistic information? Well, here comes the exponential moving average. Now it looks pretty similar. It looks pretty similar, right? But the difference between a simple and an exponential moving average is it all accounts for the same information. So let's be clear, right? The end of the line is still, because I've got, just for the sake of training, I've got a 10, the same as the 10 up there, but this is an exponential instead of a simple. The difference is that on a simple, it's just giving you the closing price of the last 10 candles. That's the end of the story. Nothing special. On an exponential moving average, it still gives you those 10 candles. However, the difference is that from here, it's going to take those last 3 or 4 candles, and it's going to put more emphasis from here forward. Now, it still accounts for this, but it really takes the most recent 3 to 4 candles, depending on you know, the size of the number you use. In this case, 10. So it's going to take 30 to 40% of the most recent data, and it's going to put more emphasis on recent data, therefore taking away spikes from drastic changes in the market from, you know, 10 candles ago or 50 candles ago. It's gonna give you the most recent data from the previous 30% of that number, 30 to 40% of that number, and it's gonna include that emphasis in where that line is. So there is a percentage, and there's an algorithm, and there's a formula that's built into it that I won't get into right now. How they accumulate that number, a lot of algebraic terms and things like that. But really, in a very simple explanation, it still gives you the price, the closing price of the last 10 candles. However, more emphasis is placed on the last 3 or 4 candles in this case. Okay? So because you're getting the most recent data rather than just simple data, you're going to have less spikes in the market. You're not going to have drastic spikes in the market, because it's really emphasizing what's currently happening in the price action. Okay? Now, with that being said, is one better than the other? Is a simple better than an exponential, or is an exponential better than a simple? Well, no, I don't think one is better than the other. I think they're different and they serve a different purpose. The simple is great because just that, it is simple. It is going to give you clear movement of what's really happening in the market. It's not really emphasizing one way or the other. It's just giving you straight information. Okay. Again, the drawdown from that, the con of the simple is that you're going to get spikes in the market. And when price action drastically changes or quickly changes, the simple doesn't really know how to account for that change so fast. So you get spikes in the line. The exponential can handle the spikes and doesn't have such drastic spikes. The problem with the exponential is because there's so much emphasis on the last 3 or 4 candles or the last 30 or 40%. Sometimes we can get faked out by an exponential, and sometimes it'll act like it's going to go into a sell, but really it's just going to start ranging and going sideways. Or sometimes it'll act like it's going long, and it'll end up just going sideways into a ranging market. Okay, let me give you an example of that. I highlighted a couple of areas back here. Generally, when we look at a situation like this, this is the exponential 10 moving average, so a 10 EMA. We see that we just came out of a short. We just came out of a long sell trend. That's confusing language. I shouldn't say long sell trend, short. But we just came out of a deep drop in the market. Price has come down substantially. Now it's starting to go back up. We have a high and then a higher low. And then we have this confusion here that it does end up setting another high, but we have this move down. We have this move up. Now all of a sudden price comes up and we say, get in. But then price ends up coming right back down. And sure, it does come up eventually, but we end up getting stuck in some drawdown there. And on a 4-hour chart, you're looking at 4, 8, 12, 16, 20. You're literally stuck sideways for an entire day because you were relying on an EMA rather than an SMA. So there is pros to the SMA, there is cons to the SMA. There is pros to the EMA, and there are pros, cons to the EMA as well. Okay. Now, what we need to understand is that one thing that the EMA is really good for is good, quick, early entry. Simple moving average, sometimes the move is already happening before we really see the entry if we're looking at just simple moving averages. We have a move that's already taken place. So let me show you what I mean by that. You see here, we have, on this particular case, it was beautiful because it bounced right off of our simple moving average and went up, retested, went up. However, notice here, this move starts going up, and really we generally wait for a new candle, but we don't like to get in a mid candle. So if we would have waited till we got to here, because this is when price action closed above the simple moving average, man, we'd have been in big trouble, you know, and not in big trouble, but we'd have missed a lot of movement, you know. And so a simple moving average sometimes doesn't give you that precise early entry. Sometimes a lot of the movement has already happened by the time the simple shows you to get in. Whereas many times, if we move forward, I'll show you. Let's look at the let's look here, where this one is a lot closer. Okay, you know, the exponential is going to give you a much quicker and earlier entry to the market. However, you run the risk of being faked out because it sometimes is too early. Sometimes it doesn't wait for the retest. You notice here on the exponential, back to our move over here, remember the retest, how it was so perfect, kissed right off the simple? Well, this one broke through, and we might have been faked out and said, well, wait a minute, it closed below the line, so now I need to go sell, and then boom, we're faked out into a buy. And so there's pros and cons. I guess that's what I'm really trying to get at, guys, is there's pros and cons to both. Neither is better than the other, and neither is bad. They're both good. They're both very good and solid, reliable indicators, but they need to be used for their own purposes. You don't try to use an exponential moving average to tell you simple information, and don't try to use a simple moving average to tell you the exponential or more complicated or more intricate information. You need to use both of them in their current, where they belong. Okay. Now let's take those off. Let's go back over here. All right. And there's a live chart. We're looking at GBP USD 4 hour. All right. Let me show you a couple of. I hope that will help you to understand what the simple and the moving and the exponential moving averages are. Probably the two most common indicators that people use. So now let me show you something else. Let me help you to understand how to use them. All right. One of the most common ways that we use moving averages is to identify trends in the market. Now we see this. And we say, we know that that's an uptrend. We know that that's bullish. We know that that is, long, okay? However, on the overall, let's kind of go here. It's interesting because if you go up, it's really just the start of something new, okay? This has been a strong downtrend for a long time. Or when you look at something like this on the 4 hour, okay, let's move our highlight there just for the purposes of showing you. All right, now let's go to the 4 hour. Let's go back and find this. Okay, so we see bullish movement right there. However, we know that it's part of an overall downtrend. Okay. So sometimes that can confuse people. Sometimes people can get kind of turned around, if you would, on, what's what. So that's where a moving average can come in and help you. Here's the simple way to look at it. Here's a simple moving average 10. When we're looking at smaller moves, when price action is above your moving average, that's generally going to be considered bullish movement. When you see price action below your moving average, okay, so your candles are below your moving average or your moving average is above your candles, you're generally looking at a downtrend or you're looking at bearish movement, okay? Same thing with the EMA. You look at downtrend because your price action is beneath your moving average. You look at uptrend because your price action is above your moving average. That's pretty simple. That's how we can identify trends. Now, here's the problem with it. Again, let's look at this simple moving average. Okay, and when we look at this, you see how it kind of will come through, and this could kind of fake us out because we're up, down. Wait a minute, we're below. So are we in a downtrend? Well, no, we're still moving upward. So we can't only rely on, well, it's above, so buy it. It's below, so sell it. You can't. It's not that cut and dry. You want to identify an overall trend by seeing this, but it's not necessarily a trend to trade, or it's not necessarily how to identify a trade right away. It's just to identify what the current movement of the market is. If we have green movement above your moving average or whatever your colors are, you have bullish movement. If you have red movement below your moving average or whatever your colors are, you have bearish movement, okay? Same thing goes for the EMA. Now, here's what's interesting. Let me compare the two for you. Let's look at both of them on the chart, okay? So now you have an EMA, and an SMA, and an EMA, okay? So you have your exponential, purple. You have your simple, yellow, okay? So let's look at both of them on the chart together. When we see sideways movement, you're going to, and I don't mean sideways as in ranging or consolidating, but the stronger the move up or down, generally the closer your lines are going to be together. The longer and more sustainable, really that's the key. The longer that your trend continues, the more you're going to see these two lines very, very close together. When you see a differentiation in these lines as they start to spread apart, like you see right here, they're not so close like they were here. That's generally showing you a change in direction. Okay, so you see right here how they start to spread apart right here. Okay, so I'll highlight this for your so you can see it right there. Okay, guys, you start to see that the exponential starts to climb and the simple just stays the course, because remember, the exponential is showing you the most recent information. The simple is showing you the simple overall information. So the simple just stays the course, whereas the exponential starts saying, wait a minute, I'm noticing a difference here. It's spiking up here, but then there's a stark move. So it starts to curve, the yellow starts to curve, and then we have a straight drop because the most recent information here is a big move. The yellow, the simple, is showing you information from all the way back here, right? It's showing you the whole average of all of that. So the simple is kind of slowly finding its way down, whereas the exponential showing you the most recent information right here is like, oh, wait a minute, this thing is going, it's going down hard. So it goes down hard. So now we start to see a little bit of separation in between these two lines. When you see that separation, that's volume. When you see that separation, that's volatility. When you see that separation, it's showing you a strong move. So when you see that a yellow is pointing one way and a purple, and in this case, a simple is pointing one way and an EMA is pointing another way, that EMA is giving you entry. That EMA is giving you a solid entry to a nice trade because it's showing you we're about to have some volume. And what happens? It crosses over right here. We see that gap in between, and boom, we see a nice move down. Okay, so that is something that you want to make sure that you keep an eye on. All right, same thing happened back here. Okay, we had some movement together. It was kind of split, spread apart, it was going down. It came together, started moving sideways and all this kind of stuff. It was kind of deciding what it wanted to do. Then all of a sudden, remember, the simple chugging away, still giving you information from back here, okay? It's not really accounting or putting more emphasis on this big move right here. It's just telling you the overall price of all of it. But when this happens, the EMA says, wait a minute, we've got some serious movement, and it starts going with the movement. Now you start to see a little separation. You have a change in direction. And here's now just up here, we're starting to see, oh, wait a minute, this big candle is really having some big information on the yellow. Well, it been had information on the purple. The purple already showed the emphasis on that. Now suddenly is that having a major impact slowly later on the yellow. So now suddenly, as it starts to change down and we start to see down movement, we start to see the purple's already starting to head down, where the yellow is still kind of trying to figure out which way it's going to go. So when we see that separation, look what happens next. Boom, nice drop down. When we start to see those things pinch together, we start to see it tapers off, and instead of having this space in between, we start seeing it taper off to come to a close. Look what happens. We start to go up. Okay, so this is just simple understanding of how an EMA, an exponential moving average, or an SMA, which is a simple moving average, just showing you how they work. Okay, now that's how you can identify trends. Oh, let me just say one more thing too concerning that. When we look at a simple, right, we see it's going up, it's above the line here, so we see uptrend. Comes below the line, we see downtrend, right? Same thing for the EMA, but there's some fake outs in there. Okay, so here's the cool thing about it. When you use both of them together, when you see both of them work together, if it's on the upside of both of them, if it's on the upside of both of these, you're doing really good. Okay, so now let's go back and look at that. Let's see right here, for example. You see it start to break above. It was below. It breaks above. You get the retest here. It breaks above. You get another little retest here. Okay. Now it's, but notice how before it was above the yellow, but kind of below the purple. So it was above the simple, but it wasn't really above the exponential in here. It was only above one of them, and it was still kind of retesting. Comes down here, it touches the yellow, so it's above the yellow but below the purple. But then it goes. Now suddenly it's above both of them. Now it's not touching or below either one of them. So now you have not only simple, but you also have exponential working together, showing you the real movement in the trend. So now suddenly when you see it above both of them, you know you've got real upward movement. Does that make, I hope that makes sense to you. Using one is good, using both is better, because they both give you the same information as far as moving average, but they give it to you differently, emphasizing each different point. And all of it is important if we want to be solid traders, if we want to have good confirmation, risk management, and understanding that we're getting in and out of the market properly. We don't want to just go, well, it's above, let's buy. Well, it's below, let's sell. No, that's not how it works. We need confirmation. We need something that's going to teach us and confirm to us what's really going on in the market. That's why an EMA and an SMA work so well together. Okay. Now, I'll show you this. This is a 50 moving average. Okay. Now, so these were 10. Let's look at the 10. Look at the difference. Notice how the 10 is kind of moving with the market. You know, whatever price action does, the line is kind of moving with it, right? Because that's giving you 10 candles. So it doesn't really take much to affect the overall average of just 10 items. If I have, 10 times 10, right, is 100. So the average of 10 is 10, right? So if I say, if I have 10 candles that are each worth 10, if I have 10 items that are each worth 10, okay, now, I take those 10 things and I divide them among 10, I get 10, right? It's pretty simple. 10 times 10 is 10. 100 divided by 10 is 10. So the average is 10, okay? Real simple. Now, let's say I take those 9. I have 9 that are worth 10, so it's 90. But the last one, the last candle, is worth 48. Now, suddenly, wait a minute. The average is no longer 10. We have a big jump in what that in what the average is, because now suddenly we're taking 136 and dividing it by 10. So now the average is 13.6. So one little candle that's worth a lot more, because we're only dealing with 10 items or 10 candles, right, in this case, could really affect the price pretty drastically. So we could catch a lot of pips on one candle. We could have a lot of movement and affect that moving average by a lot in just one candle. Now, let's take 50, all right? Let's take 50. The moving average is the same, right? It's the same principle. But instead of 10, it's 50. So now we're taking the last 50 candles. The last 50, so we're talking 4 hours times 50, right? So we're talking 200 hours of movement in the market. We're talking about 54-hour candles or 15-minute or whatever chart you're on. And we're taking the closing price of all 50 of those and dividing it by 50. And that's how we get the moving average, the 50 moving average. So with that being said, if you have 49 candles that are generally staying around the same price, 49 times 10, you have 490, but then you have one that's worth 50, right? So now suddenly you have 540. 540 divided by 50, right, is, what do we got, 10.4, right? So suddenly we went from being worth 10 to being worth 10.4. Really not that big of a difference, because the overall price is a much larger sample size. So one jump in price is not really going to make you spike out when you're looking at a longer time period. So I hope that makes sense. when we're looking at a 50 moving average or 100, some people use 100s. I've even seen people use 200. But when we're looking at that, you're generally going to see a line that doesn't really waver very much. You know, it moves, sure, but it takes a lot to really move the 50 moving average. It really start, you know, when you start to get 5, 6, 7, 8, 10 candles moving in another direction, you start to see that 50 start to climb with it or you know, go down with it, right? So I'll give you an example. Look right here. 1, 2, 3, even though that's, you know, that's not really green, but not a big deal. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 candles, all downtrend, with the exception of a couple little pullbacks in there. You're talking about 15 candles of complete bearish movement. And just now, this boy's flat, just starting to kind of curve over to turn downward. Now, if this was a 10 moving average, which way would that be pointing? Right? A 10 moving average, man, this is a straight downtrend. I mean, we're talking about a hardcore downtrend. But when we're looking at the 50 moving average, it really hasn't been affected that, you know, as harshly. So here's the thing about a higher time frame moving average. You're going to get a very clear picture of your trend. Okay? When you use a higher time frame or a higher number on your moving average, let's say 50, when it's retesting that line, that's a major you know, occurrence. That doesn't happen, you know, at just every day. So I mean, let's look back. Let's just start here. Down, 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 down. It comes up and touches that line. So that's once. How many days was this? You know, you're talking what, 30 candles there probably, you know. So, or maybe more, 40 candles. Then suddenly, boom, one touch. Comes up. Boom, we have a touch. What do we got? Another 20 candles. Comes up. Another 15 candles. Comes up. Got another 10, 15 candles. Now we got some sideways movement. But then boom, because we had a major zone right here. This right here, when you look back, let's drop a line on it. Look at that zone, guys. Look at that zone. Right? So we have a zone there. When we see the 50 moving average being tested by price action, that is not the time you want to be holding out a trade. Okay? This is the time where you want to be saying, okay, what is about to happen? Let's see what happens. Because once the move does happen, it generally lasts a while. Okay? It generally, once it does push off, because we're talking about such a large sample size, because we're talking about such a large portion of information, it's not something that's going to change just, you know, at the snap of a finger. This kind of a trend takes some serious selling pressure to break it. Okay? So when we see something that's above the 50 moving average and it's not retesting it, sure, you're going to have some downtrends in there. You're going to have some downward movement in there. But overall, we're looking at a big move. And this is how swing traders, you know, use moving averages. They use higher numbers, higher sample sizes. So with that being said, I hope that makes sense to you as well. Let's look at crossovers. Now, that's what a lot of people use when it comes to moving averages. They will use what's called a moving average crossover. Okay, let's get rid of the 50. Now, in here, we're looking at a 9 and a 21. Okay, we're looking at a 9 moving average and a 21 moving average. Okay, so here's the interesting thing. Remember, the higher the time frame, the harder it is to move it. So when we're looking at this 21, this this big move down is kind of just like, oh, yeah, I know, I'll get there when I get there. You know, This big move up is like, oh, I'm just making it down here, and you're already ready to move up. And oh, I guess it's been moving up. Got a couple of big wicks. Now it's starting to move. Oh, I'll catch up to you. Slowly moving. A big move down. Oh, wait a minute. Wait. See, but the smaller one, the 10, is kind of just like, or the 9, I mean, is really following closely with the price action. It's like, okay, turn down. All right, turn up. All right, turn up. Up, turn down, up, down, up. You know, it moves with it because we're only talking about 9 candles worth of information. Okay, so how do we work the crossover? Well, we use the higher time frame to give us the overall trend, and we use the lower time frame to give us the entry. Okay, so when you have a 21 moving average and it crosses, and now suddenly price action is on top of the price action is on top of the moving average, the 21 moving average. I'm sorry. Price action is up, right? Going up. Once it crosses down below, we're back going down and down. Okay. The red is going to give us entry. So what we do, let's just say right here. Let's use this one. Okay, so we highlight it right here. Okay. All right, guys. Let's look at this. So on a 4-hour chart, the 21 moving average, now suddenly this green goes above. We're still heading down because we're looking at all this information back here, 21 candles. Suddenly, price starts to go up and crosses above the average of the previous 21 candles, which is what we call a zone. Think about it, guys. If you were to count 21 candles, put the line somewhere in the middle, you know, I would almost venture to say that every time, you're not going to be right on it, but you're going to be very close to what that average price is. If you take all 21 of these candles and find the closing price of each one of them, okay, you're going to be somewhere in the middle of this price action, okay, which is right here, right? So now, as price begins to move up, suddenly the current price is above the average of the old price, right? So let's get rid of our line. All right. So suddenly price crosses above the green, or what we call the 21 moving average. So now we're signifying a retest. And so, you know, we have retest, and it's a continual up movement. Simple, you know, trading stuff that you should have already learned by now. You have, you know, highs and lows and highs and lows and highs and lows and highs and lows, right? You got higher high, higher low, higher high, higher low. That signifies an uptrend, or what we call a bullish trend. Okay. Now here's the cool thing. It's coming down. Price moves up. The 21 moving average is still slowly working its way to kind of cup hold, or like kind of support the uptrend, right? But the red, or the 9, being quick, ready to go, it's moving with it. See this little crossover right here? Got it marked for you. See this little crossover right here? When you see that red line cross over, when you see it cross over, that is generally going to be a good place to enter a trade. Now, I'm not telling you that that's the only thing you should use to enter a trade. I'm telling you that when you see the smaller time frame, or the smaller sample size, in this case 9 and 21, when you see the 9 cross over the 21, that is the direction that the trend is going. Okay, so now it crossed over right here. So let's just say we were to got in right here. Okay, let's just drop a line. Let's say we would have got in right there. All right, and if that's the case, we would have gone to our previous low. and set our stop loss. Okay, so this would have been your risk. In this particular case, you would have been risking a total of 98 pips. So this is a larger long-term trade. Okay, this is not a scalp, this is a swing trade. But you find the crossover, you're risking 100 pips, and look what ends up happening. Do you ever find, does it ever get to your stop loss? Nope. Nope. So here's what you do. The crossover happens, you press buy. Okay. Now, you're in. And when it crosses back over, right there, you get out. Because now, what are we signifying? We're signifying a downtrend, right? Now, because it crossed back over, we're no longer looking at a long, we're looking at short now. We're not looking at bullish, we're looking at bearish now. So it crossed over up, we get in. Crossed over down, we get out. Probably the simplest form of trading that there is, okay? You risked 100, but what did you catch? 286 pips, 285.9 pips. So in this particular case, was that a profitable trade? Absolutely. Now, is that the only thing you need to trade? No, not at all. I'm just telling you, this is how you use a crossover. When you're using moving averages, you want the smaller time frame to cross over the larger time frame, showing you the change in direction and the precise entry. You get in, you set your stop loss below the previous low or above the previous high if it's a short, and you get in until it crosses. That is how you trade crossovers. That is how you effectively use moving averages. This is the last video you will ever need on moving averages. Guys, when you watch this video, you should be a master on moving averages, because I just showed you how to use moving averages to get trades that are going to be 1 to 3 risk reward. You're gonna be risking $1 to get $3. That's simple math. That's good trading. Well, now if I'm trading 1 to 1, that's not good trading. I'm not going to risk $1 to get $1. That doesn't make sense, right? So that's another video for another time. I'll do a video on risk management and trade plan later. But when you're coming to trade the moving average, this is how you do it. Okay? Now, last but not least, that last thing I'm going to show you on this. Let's go back to the 50. Okay? Let's just use this for an example. Actually, you know what? Let's use the 10. How can we use support or the moving average to really give us support in the market? Now watch this. I'm going to show you something that's really going to mess you up, guys. I'm really going to show you some awesome stuff here. Let's take this off. I'll take that off for a second. Let me show you something really cool. Okay. Let's say there. Let's say, and I would never mark a chart up like this. I'm just showing you for the purposes of this training. Say there. Got a nice resistance, support, right? Okay. Let's say here, a nice little zone, right? Resistance, support, resistance. And let's do one more. Let's go down some. Let's show you down here somewhere. How about that? Let's go here. All right. Now, you see those lines? Now, you should, if you're in this video, you should be beyond support and resistance. You should know support and resistance at this point. But let's just say you got a couple of zones here, a couple of key zones. You got a couple of key levels right here. Okay, watch this. Here's what's really cool. When you see these zones, you're also going to generally, not every time, but you're going to, in many cases, you're going to see touches. Okay, it's called convergence. What you're going to see is right around this zone. And now, anybody who tells you it's exact every time is lying to you. Okay, generally, when we mark up a chart, you actually should be marking up a zone, really. So technically, you know, when you're really marking up support and resistance, you should be marking up a zone. Okay, So you probably already know that, but just for your own, clarity here, I just want to make sure that we're understanding. All right. I think you get the point. When you see these zones, these support and resistance zones, you're also going to be able to see, watch this, comes up into the zone, and notice how it's on the line. These touches on the line are important. Right here, okay, goes in here, touches. Now, again, sometimes it's not exact. You got wicks involved and all that. Touches, right? Breaks through. Touches up here. Touches. What you're gonna generally find, I guess, the point I'm trying to make, and I'm gonna take those off. Your moving average is generally going to be a moving support and resistance line. It's going to be a dynamic support and resistance. It is going to move with your price action, and your price is going to move, and it's going to try to bounce. Okay, if you think for 1 minute that you're just going to go straight up, it's not going to happen. It's going to go up and touch. Sometimes it'll break through a little bit, which is why we don't just trade off of one line. Goes up, touch, up, touch, up, touch, up, touch, up, touch, up. Come on, guys. I mean, you get the point, right? Down, touch, down, goes up, retest, touch, breaks, touch, breaks, touch, breaks, touch, right? Every single time, because your moving average is not only going to act as the average of the last 10 candles, 50 candles, 100 candles, whatever it is, but because those levels, because price generally repeats itself, because these important levels and key levels in the market are going to repeat themselves over and over again, and you're going to see price test those same levels all the time, what you're going to end up seeing is that because that happens, your moving average is going to act as a moving support or resistance line. It's going to come on the top, and when it's a bullish move, it's going to test to the downside. When it's a bearish move, it's going to test to the upside, because your moving average is going to be a moving support or resistance line for you. Another reason why we don't use one. Let's look in this case. Now, let's just say you were trading the simple, the exponential, and the larger time frame. You break, retest, and break. So now with that break, we know we're above the 50. Man, we're looking good. We're looking good. Okay, this boy's gonna go up, right? The smaller ones, remember the smaller crosses over the bigger, right? The smaller ones break down and cross over. Remember how I told you how to do that? The smaller ones cross over, and when the smaller crosses over the bigger, what do? We enter, right? So what would happen if you had got in here? Let's look at it. If you get in right here, all right, and let's say you would have set your stop loss right here, okay? Oh, I pressed the wrong button. Sorry about that. If you'd have got in right here, you wait for the retest. You set your stop down here below that. Okay. We were looking at a total risk of 145 pips. It's a big risk. However, we stay in until it crosses, right? And remember, you can take profit at any time. You don't have to stay in all the way till it crosses. Sometimes you can get out at high points. All right. Now, if you got out here, it would have been 358 pips. But when you see this strong down movement, you see that purple begin to cross back over, you know you're going into a sell. So you got 292 pips. But if you would have waited all the way to the crossover, you're still at 204 pips. So you caught a 204 move, but you would have been long out by then, you know? So the point I'm trying to make, guys, is if we will use moving averages, the most simple indicator that there is it is the most simple indicator that people use, okay? When we look at that and when we use them properly, we use them for what they're supposed to be used for. Simple, for simple information and a steady, smooth flow in the market. Exponential, for a quick and early entry, but beware of fake outs. The smaller time frames for quicker and smaller moves. The larger time frames for longevity, swing trading, to show the overall trend of a market. And crossovers for great trading strategy, moving average crossovers. Support and resistance and identifying trends using your moving averages is brilliant. You're going to understand how to use moving averages, and you'll be a much better trader simply by understanding that. But I want to say one last thing before we close this video. Guys, after I showed you all that, okay, let's go back here. After I showed you all that, now there's no lines on the chart. There's no moving averages on the chart. Having seen what you just saw with moving averages, having understood exponential versus simple, having understood the lower sample size versus the larger sample size, understanding the dynamics of what each moving average does, understanding the crossover, without having to look at anything, just by dropping a couple of lines in the chart. You think you can start identifying some of this stuff? Because I'm going to tell you something. The indicators themselves are not the be-all, end-all of trading. They are there for confirmation. We do not use, successful traders do not use indicators as the primary source of trading. They use them as confirmation to what market structure and price action already show them. The simplest form of trading, price action trading, is the most successful and sure form of trading. You cannot base your trades on indicators alone. Let me tell you why. And this is my soapbox for all you traders out there, okay? Indicators by nature, no matter what they are, moving averages, Bollinger Bands, RSI, MACDs, ichimoku, stochastic, whatever it is you use, okay? All of them, by nature, are reactive. They cannot act until the market acts, right? They cannot do what they are going to do until the market does what it is going to do, right? I hope that makes sense to you. Because in a moving average, how can I know where this is going to be unless I'm taking the previous price or previous information? So this information has to happen before this can happen. I hope that makes sense. If you trade off of indicators, you're forever going to chase the market. The market is already moving, and you're telling the indicators are now they're telling you what to do. So you're getting in late, you're getting faked out, you're missing trades, you wonder why you press buy it and suddenly it went red. Guys, don't trade the indicators alone. Understand how to read market structure. When you can start reading support and resistance, when you can start reading zones in the market, when I can look at a thing right here and I can say right there, this is a major zone. So when it finally breaks and really breaks good and has a retest, when it breaks and has a retest, I know that I'm going to end up going to the bottom of the zone. So what happens? It comes down, fakes out, comes down, retest, boom, I'm heading in. Right now, currently, if you were on this video live right now, you could say, man, this is a strong move down because why? I had to move down, the retest, and I understand zones. Okay? It's really just that simple. However, when I look at that, what are the indicators telling me? They're telling me what I just told you, right? They're telling you what I already told you but I didn't need the line to tell me that. I understood that based off of what the candles told me. I would encourage you guys to trade price action. I would encourage you guys to start learning how to read the market structure, understand how to read your candlesticks, understand support and resistance, understand trends, understand supply and demand zones, understand the basics of market structure and price action trading, and then use indicators to confirm, not to tell you what to do, but to confirm what market structure already said. I hope that makes sense to you guys. That's the end of this video. We'll see you on the next video tonight. I hope you learned a lot about moving averages, and make sure you like, subscribe, comment. We got a lot of great content coming, a lot of awesome trading and training and live sessions and all kind of great stuff. So make sure you like, make sure you comment, make sure you subscribe, and let's get it. Let's get in these charts. See you on the other side.